Hey, finance experts. Today we're going to be looking at Plains All American Pipeline LP for my Sellside report and why you should be buying into it. So their sector is energy. Their industry is oil and gas, and they're traded on the New York Stock Exchange. Here's a little bit of view of their website. So a little bit of information about them is Plains All American Pipeline, in its own words, is a publicly traded master limited partnership that owns and operates midstream energy infrastructure and provides logistics services for crude oil, natural gas liquids, and natural gas. PAA, which is what it's short for, owns an extensive network of pipeline transportation, terminaling, storage, and gathering assets in crude oil and natural gas liquid producing basins and transportation corridors, and at major market hubs in the United States and Canada. This company is mainly based in Houston, Texas, and has been since their inception in 1998. With Plains GP Holding LP as its parent company, PAA has been in a few legal matters heard about in such companies such as like the Little Buffalo oil spill in 2011, the Rangeland pipeline incident in 2012, and the Refugio oil spill in 2015. But like many oil and gas companies, these types of incidences only help the company grow and move on to become more safe and profitable. And so when looking at a company, we want to look at their ratios. So let's go ahead and do a ratio analysis of this company. When looking at a company's short-term solvency, which is its ability to pay off short-term debt, it's best to look at three different ratios: the cash, current, and quick ratio. All three right here. Cash ratio shows how much cash the company has to its current liabilities. Current is the company's current assets to its current liabilities, and quick shows the company's total assets over its current liabilities. Now, what you can see from 1998 up here all the way to 2018, they have extremely low short-term ratios. So that can only be shown that but with the lowest being a cash ratio, it's almost zero in all years of business. While most would consider this a bad thing, it could also just mean that PAA doesn't really carry around too much cash. Next, looking at the past 3 years, which we're just going to be looking at 2016, 2017, 2018. Let me go ahead and freeze first column to make it easier to look at this thing. Just those three. Okay, we'll be looking at those three. Just looking at the past 3 years of our ratio analysis, PAA has kept a high debt to equity amount at around 3 from 2016 to 2018, as you can see right here. This ratio shows that this company is very much able to handle their debt and turn it into an event where funds are needed quickly. It means that they're able to manage the debt to equity management. Showing ratios of asset turnover around 1.05 to 1.1 in the past 3 years is a good sign the company has shown efficiency in using its assets to generate revenue. So far, in all ratios shown, as we see here, the higher the better. So the PAA's return on equity, which is something you want to look into as an investor, is extremely high at 8.61 in 2017. Let's see, 8.61 return on equity, 2000. There you go. Showing that they are in fact making great gains in comparison to the amounts of dollars investors are putting forth into the company. Also, the company has an incredibly high tax burden and interest burden, showing that they are in no danger of being able to pay off any debt or taxes put onto them. So right here we have the tax burden and interest burden. As we can see, incredibly high numbers. 2017, 75.94 and 63.88. That is just incredibly high. So that means they could definitely pay off whatever tax burden they have or interest burden that they have. Moving on, we have lastly looking at the price to earnings ratio, which is what we really want to look at as an investor. The price to earnings ratio and the price to book ratio, we see a very high price to earning, indicating that compared to the price of share in the market, PAA is generating a tremendous amount for a company at its price point. So looking here, it's actually at 11.08, which it was way higher in 2016, but still 11.08 is a really good number. Its price to book ratio is not as high, but it's still higher is better. But it's still doing good. So that should give enough for our ratio analysis. It's showing great numbers so far as a company. Now looking at its economic value, we pulled this out of Bloomberg. What we can see is its capital structure. So looking at PAA's equity, we can see how well the company is doing, where all its funding is coming from, how much money is how much of it is coming from each group, such as creditors or investors, and if they're making as much money as they expect to off the money investors are putting up. So up here we see the amount each group is putting up. So as you can see, most of their money comes from equity. As you can see, it should be around 68.1 on equity, 7.6% of that being preferred stock, and 31.9 of the remaining weight in debt. As we can see, most of the money comes from investors. Up here, you can tell if we just add the equity and preferred equity, it will give us a WACC, or weighted average cost of capital, 7.9%. We'll need that for down here. The company is NOPAT. We can see that the company was able to make $1,644.86. Well, we'll just say $644 million. I'm sorry, in profit after taxes. To see how much money a company was planning to make through investment, we take the WACC and multiply that by the total investment capital and get the capital charge, which is right here. That's as much money as they expected to earn. Again, while some might see this as the PAA's capital charge, the money they expected to make off investment is much higher than NOPAT, which is the actual amount of money made off investment. So we have, this is the actual amount of money they made, and this is what they this is what they expected to make. So you subtract the capital charge, what they expect, from NOPAT, what they actually made, and you get the economic value added, and we see that they actually are $462 million lower than what they expected to make off the amount of investment earned. Again, while some might see this as a bad thing, one has to realize that a vast majority of PAA's funding is through investors, and that their earnings ratios are actually through the roof. So they're just putting themselves at a high bar. So, in conclusion, let me go back to their website. Plains All American Pipelines LP is an incredibly large company working on one of the biggest and most needed industries in this era. Going off the ratios analysis alone, the company does not show too much promise on how well they handle their short-term debt, but their asset efficiency and earnings ratios are as good as gold. As an investor with shares being at only $22.30, I think it has it down here. Yep, $22.30 right there. At a current price, one find it very appeasing to invest in PAA. While most of their funding does in fact come from stockholders already, the amount of earnings per share should have investors running to buy as many shares as they can from PAA. Looking at the assembled date, looking at all the assembled data, Plains All American Pipelines LP should be a must buy. Again, this is my Sellside report, and hope you learned something.